Houlihan Lokey is a US mid-cap stock that relatively few people are aware of, but it's exactly the kind of stock that we love to discover. Because first and foremost, it's a high-quality company and a leader in its field. And on top of this, it's a stock that fits in really nicely with the rest of the portfolio. Let's start with a quick company overview and then take a look at the specific characteristics of the stock that really appeal to us. Houlihan Lokey is a boutique advisory firm based in New York. It was formed all the way back in 1972 and it's been listed on the New York Stock Exchange since 2015. It specializes in two main types of advisory work. Number one, mergers and acquisitions, and number two, restructuring mandates. Now, most of you are probably familiar with mergers and acquisitions, or M&A. On this front, Houlihan Lokey specializes in mid-sized deals, and it's the number one advisor in the US in terms of number of deals done, and it's a top 10 advisor globally. The other big part of the business, restructuring, is even more specialized. In a restructuring, Houlihan Lokey will be called in to advise a company that has found itself in financial difficulty, and this can often take the form of a debt restructuring or a bankruptcy restructuring. This business isn't quite as big as the M&A business for Houlihan Lokey, but it's an area where the company has an even more impressive market position. It's the global leader in financial restructuring mandates, and it's advised on 12 of the 15 largest US bankruptcies since 2000. Now, while we like both sides of the business, what we like even more is the way that they complement each other. Because M&A and restructuring both go through cycles. M&A activity tends to be strongest when markets are hot, like right now. And restructuring activity tends to be strongest when the economy hits a pothole and a lot of companies start to go bankrupt or struggle to handle all of the debt that they've built up during the good times. Therefore, with Houlihan Lokey being strong in both of these areas, this acts as a natural stabilizer, and it makes the overall business a lot less cyclical than most of its peers. When we did our initial due diligence on the company, we were able to verify that this actually works in practice. For example, in the wake of the GFC, the company's M&A revenues almost halved, but its restructuring revenues skyrocketed, enabling the company to come through that period, which was an absolute horror story for most financial institutions, relatively unscathed. The same benefits of diversification were evident last year through the COVID crash and the subsequent recovery. Even though, as the saying goes, every crisis is different, things played out well again. This time around, the slump in M&A activity was less severe than it was post the GFC, while the jump in restructuring activity was less pronounced than it was after the GFC, because as you know, governments and central banks are doing their very best to stop overgeared companies from having to deal with the consequences, for the time being at least. The other thing about the company that appeals to us is that through all of its growth, it's managed to maintain its specialized boutique mindset and hold on to its partnership culture. It also has very strong staff retention as well as broad-based share ownership by its staff. It has very, very low key person risk, with no individual generating more than 2% of the company's revenues. And unlike many of its peers, it runs a capital-light business model. It takes no balance sheet risk and it doesn't rely at all on trading profits. And finally, and just as importantly, the stock has really strong fundamentals and it has an undemanding valuation. We get an attractive free cash flow yield of well over 5% from the stock.